Welcome to a new deep dive on the Gap Advisors Ind AS Clinic podcast.
Glad to be here. Looking forward to getting into this one.
Yeah, me too. So when you look at a set of corporate financial statements, the natural inclination is to just view them like a photograph, right?
Yeah.
Like a high-resolution snapshot of a company's reality.
Right, yeah. People assume they're seeing just this direct, unvarnished reflection of what actually happened.
Exactly, over the last 12 months or whatever. But a balance sheet isn't really a photograph. I mean, it's more like a highly technical translation of a novel.
Oh, I like that analogy.
Thanks. The underlying events are the raw story, but the accounting standards, like the grammar and the syntax, they dictate entirely how that story is actually perceived.
That's exactly the right framework to approach this with. I mean, much like any complex language, if you don't understand the rules the author is bound by, you're going to completely misinterpret it.
Yeah, you might read a massive positive number and just assume, wow, this company generated immense operational value.
Right. When in reality, the specific syntax of the accounting standard just allowed them to, present an internal reshuffling of assets as a gain.
And navigating the intricacies of that exact syntax is what we're tackling today. So I'm thrilled you are joining us for this deep dive.
It's going to be a fun one.
It is. We are unpacking a highly specific, fiercely debated corporate accounting scenario today.
Yeah, one that really tests the limits of how companies recognize gains.
Exactly. And it gets into this profound clash between legal maneuvering and accounting standards. Plus, we're going to look at the surprisingly persistent myth of mere accounting.
It's a phenomenal case study, honestly,
Yeah.
because it forces us to strip away those surface-level numbers and really examine the underlying economic engine.
Especially when you have subsidiary and parent companies transacting with each other, right?
Oh, absolutely. That's where things get really complex.
So before we get into the actual mechanics of this transaction, we do have to establish a few mandatory disclaimers.
Right, the ground rules.
Exactly. First up, the views expressed herein are the personal views of the author of our source material and are not binding on you, the audience.
Very important to note.
Yeah. We strongly request that you seek the help of a qualified expert before taking or, refraining from any action based on the views we discuss herein.
That's essential context. Because the application of Indian accounting standards is just highly fact-specific. I mean, slight variations in a contract can entirely change the outcome.
Precisely. Now, for the foundational ground rules for the actual scenario we are dissecting today.
Let's lay them out.
Okay, so the functional and presentation currency is the Indian rupee.
Right.
Therefore, any currency other than the functional currency is considered a foreign currency.
Got it. And the reporting period.
The beginning of our reporting period is the 1st of April, and the end of the reporting period is the 31st of March.
Perfect. That sets our operational parameters.
Hmm.
So where exactly does this specific thorny issue come from?
Right, so the source material for today's deep dive is pulled directly from the issue repository on GapAdvisors.com.
Oh, yeah, that's a massive resource.
It really is. This platform hosts over 4,500 highly specific issues, along with detailed responses concerning Ind AS and Indian GAAP.
I mean, for professionals in the field, this repository is essentially the ultimate technical backstop.
Yeah, it's wild. And anyone can actually register on the site for free, right?
Exactly. You register for free, and you can submit your own complex issues on Ind AS and Indian GAAP.
And then they just send you the answer.
Yeah, you receive a rigorous, technically sound response delivered directly to the inbox of the email you registered with.
That is incredibly helpful, especially for an auditor who's sparing down some contentious treatment proposed by management.
Oh, absolutely.
Yeah.
Having that concrete, authoritative documentation to justify how you addressed a specific Ind AS application is just indispensable.
It provides the ammunition for those tough boardroom conversations, for sure. So our specific case study today was actually featured in the 213th edition of the Gap Advisors Task Weekly newsletter.
Authored by C.A. Manish C. Iyer.
Yes, exactly. The director at Gap Advisors. This newsletter is published on LinkedIn, and there are over 230 editions published to date.
It's a gold mine. If you are registered on LinkedIn, subscribing to this newsletter for free is an absolute must.
I couldn't agree more. And for our listeners who are currently wrestling with their own tangled accounting issues.
Which is probably a lot of you.
Right. If something we touch on today mirrors a transaction your firm is dealing with, you can actually book a one-on-one consultation.
Oh, really? With the author
Yeah,
directly.
directly with him. You can book time to discuss your Ind AS and IFRS issues from his page on topmate.io.
I highly recommend utilizing that direct access, especially if you're dealing with the material impact of these standards daily.
So, before we get into the weeds, we need to address the immediate so what factor.
Right, why should anyone care?
Exactly. Why does a retail investor who's putting their hard-earned money into shares of a listed company need to care about the friction between standalone and consolidated reporting?
Because, frankly, if an investor doesn't understand these mechanics, they are entirely blind to engineered optics.
Engineer optics. I like that phrase.
Yeah, I mean, accounting standards basically define the perimeter of corporate truth. So, if an investor sees a massive spike in a subsidiary's standalone P&L,
They might just model out higher future cash flows, right?
exactly, they assume the core business operations are just booming.
But what if they aren't?
Well, if that spike was generated simply by selling an asset upward to the parent company at a premium,
Just an internal transfer of wealth.
right, then no actual new value was created for the consolidated group at all.
Oh, wow. So the investor's pricing in operational growth, it simply does not exist.
Exactly. It's like reading a nutritional label. If you don't know the difference between natural sugar and added sugar, you're going to make bad choices.
That's a great analogy. Understanding the standard is the only way to separate genuine external yield from internal financial engineering.
So let's lay out the precise facts of this internal transfer. What are we looking at?
Okay, we have two entities here. X Limited, which is the subsidiary, and Y Limited, the parent company.
Okay, a standard common control scenario.
Right. So X Limited decides to hive off and sell its entire retail business division directly to Y Limited.
The structural dynamic here is super important because Y Limited controls X Limited. The ultimate controlling shareholders on both sides are identical.
Right. This isn't an arm's length transaction in an open market.
Not at all.
Yeah.
The pricing and terms are entirely dictated by the parent.
Let's look at the actual numbers. On the date of disposal, the carrying amount, so the book value of the net assets of this retail business was 150 rupees on X Limited's books.
Okay, 150.
And X Limited transfers this business to Y Limited for a consideration of 200 rupees.
All right, so that's a straightforward gap. Net assets worth 150 rupees are handed over, and consideration of 200 rupees is received.
So there's a 50 rupee difference, a 50 rupee gain.
Yes, and we know exactly what the parent, Y Limited, did with this, right?
We do. The source material outlines that Y Limited recognized the acquired assets at their cost and logged that 50 rupee difference as a negative capital reserve.
Ah, okay. So they completely bypassed their own P&L and adjusted equity directly.
Exactly. Which, I mean, is that allowed?
Well, yeah. It's exactly what we would expect under the specific business combination rules for entities under common control, which we'll unpack a bit later.
Okay, so they treated it as a structural reorganization of capital, basically, not an operational expense.
Right, but that establishes the core dilemma here.
It does. The inquiry submitted to GAAP advisors asks a seemingly simple question. On the standalone individual financial statements of the subsidiary, X Limited, what is the treatment for that 50 rupee gain?
That is the million-dollar question, or, well, 50 rupee question.
Right. Does it run through the profit and loss statement, immediately impacting reported earnings? Or does X Limited route that 50 rupees directly into their own capital reserve?
Essentially utilizing mirror accounting to perfectly reflect the parent company's treatment.
Yeah, exactly. And the instinct to apply mirror accounting here is, incredibly strong.
It really is. It appeals to a basic human desire for symmetry, you know.
It goes beyond aesthetic symmetry, though. I mean, if you're preparing the books for a corporate group and, the consolidated statements eventually eliminate these intergroup transactions anyway.
Why wouldn't you just align the standalone treatments from day one?
Exactly. If the parent treats the premium as an equity transaction because it's under common control, logic suggests the subsidiary should also recognize the gain as an equity transaction.
It seems highly efficient.
Yeah.
But the source material dismantles this instinct completely.
It really does. The definitive answer provided is that in the individual financial statements of X Limited, that 50 rupee gain absolutely must be recognized in profit or loss.
Straight to the P&L.
Yeah. And the concept of mirror accounting is explicitly described in the text as conceptually baseless.
Wow. Conceptually baseless is a profound rejection.
It really is. It means the entire foundational premise of symmetrical accounting between related parties is flawed under Ind AS.
Well, we have to understand why the standard setters took this hardline stance.
Mm-hmm.
I mean, Ind AS is designed to reflect the specific objective economic reality for the individual reporting entity.
Right. So when X Limited sits down to prepare its standalone statements, it has to look at things in isolation.
Exactly. From its own isolated perimeter, X Limited gave up an asset, it received consideration greater than the carrying amount, and therefore it realized a gain.
And the framework dictates that gains on the derecognition of assets flow through the P&L.
Period. The fact that the counterparty happens to be the parent company doesn't matter.
And the fact that the parent applied a completely different standard to its side of the ledger doesn't alter X Limited's reality either.
Not one bit.
I really want to dig into how the source proves this point because it's fascinating. It doesn't just rely on the standard for asset disposal.
Oh, it brings in some heavy hitters.
Yeah, the author uses other massive accounting standards to demonstrate that Ind AS actively enforces asymmetrical accounting. He brings up Ind AS 109, dealing with financial instruments.
And Ind AS 116, dealing with leases.
Yes. This is where the analysis becomes incredibly robust.
By pointing to those two, the author proves that the lack of symmetry isn't just some glitch in the matrix. It is a fundamental design feature of the modern reporting framework.
Let's break down the lease example first, because Ind AS 116 completely revolutionized the balance sheet.
Oh, totally. I mean, before this standard, if you leased a fleet of delivery trucks for 10 years, it operated somewhat symmetrically.
Right. The lessor logged rental income and the lessee logged a rental expense. Nice and mirrored.
Exactly. But Ind AS 116 shattered that mirror completely.
Why? What changed?
Well, the standard setters recognize that signing a 10-year lease for a fleet of trucks isn't just an ongoing service agreement. It is, fundamentally, a financing mechanism.
Right, because the lessee has essentially acquired a massive economic asset, the right to use those trucks for most of their useful life.
Exactly. And at the same time, they've taken on a massive, unavoidable financial liability to pay for them.
So under Ind AS 116, the lessee can't just log a monthly rent expense anymore.
No, they have to capitalize the lease. They recognize a massive right-of-use asset and a corresponding lease liability for the present value of all those future payments.
Wow, so their balance sheet instantly expands.
Huge expansion. And their P&L takes a hit from depreciation and interest expense rather than just straight rent.
Okay, so if mirror accounting were a real principle, you would expect the lessor, the company that actually owns the physical trucks, to be forced to radically change their accounting too, right?
You would think so. You'd expect them to de-recognize the physical trucks and recognize a massive receivable.
But they don't do that.
No. Assuming it's classified as an operating lease, the lessor's accounting under Ind AS 116 remains largely unchanged.
That is wild.
Yeah, they keep the physical trucks on their balance sheet, they continue to depreciate them normally, and they recognize lease income on a straight-line basis.
So looking at the exact same contract, the exact same piece of paper, the lessee is running a right-of-use asset, a financial liability, depreciation, and interest expense.
And a lessee is running a physical asset, standard depreciation, and straight-line revenue.
There is absolutely zero symmetry.
None whatsoever. And the source text points to Ind AS 109 regarding financial instruments to hammer this home even further.
Right, let's talk about that. Because two entities can hold the exact same financial instrument, but account for it in entirely disparate ways.
Right, say Company A buys a bond from Company B.
Okay.
Company A might classify that bond at amortized cost because their whole business model is simply to hold the bond to maturity and just collect the contractual cash flows. But Company B, the issuer, might be managing that liability differently. Or, say, another investor buys the exact same bond from the market, but holds it in a trading portfolio.
Oh, right. Then they have to measure it at fair value through profit or loss.
Exactly, which subjects their P&L to wild market swings based on interest rate changes.
So the standard doesn't demand that the holder and the issuer, or even two different holders, mirror each other.
Not at all. It demands that the accounting reflects the specific, localized economic strategy of the entity holding the pen.
That is such a crucial takeaway. Applying this back to our primary transaction, X Limited realizes a 50 rupee gain on the sale of its retail division.
And NAS mandates that derecognition gains hit the P&L.
Right. The fact that Y Limited utilizes Ind AS 103 to park their side of the transaction in a negative capital reserve has literally zero bearing on X Limited's standalone obligations.
Zero. The logic is airtight. The spreadsheet dictates the P&L treatment.
But this is exactly where the inquiry submitted to Gap advisors throws a massive real-world legal curveball.
Yeah, here we go.
Because companies, especially those under common control, they don't just rely on accounting theory when there are millions of rupees at stake, do they?
No, they bring in the lawyers.
They bring in the lawyers and they go to the courts.
Yep.
So the second question from the source material asks, what if X Limited and Y Limited orchestrate this exact asset transfer through a formal court scheme?
Oh, all right.
And what if the language of that court scheme explicitly, legally mandates that X Limited's 50 rupee gain must be charged directly to reserves and surplus balances?
Intentionally bypassing the profit and loss statement entirely.
Exactly. Does the gavel beat the spreadsheet? This represents the ultimate jurisdictional clash.
It really does. We are no longer just debating the interpretation of an accounting standard. We're asking whether a legal mandate from the judiciary can forcibly override the financial reporting framework established by the standard setters.
Right. If a high court judge reviews the scheme, signs off on it, and issues a binding order stating the 50 rupees goes to the capital reserve, how can an accountant's spreadsheet possibly stand against a judge's gavel?
Well, the response in the source material is brutally uncompromising on this.
What does it say?
It states unequivocally that executing a transaction through a court scheme does not alter the requirements of Ind AS.
Wow.
Yeah. The standards do not bow to the scheme. The scheme is supposed to conform to the standards.
And the source places the burden of this enforcement squarely on the shoulders of the auditor, right?
Yes, and this is a critical mechanism in the Indian regulatory landscape. Before a company can even finalize and enact a court scheme of this nature, the auditor is legally required to certify it.
Certify that the proposed accounting treatment embedded within the scheme is actually in accordance with Ind AS.
Exactly. So if X Limited presents a draft scheme stating they will bypass the P&L and put the 50 rupee gain straight into reserves,
The auditor has to act as the gatekeeper.
they do. They have to formally state, Ind AS requires this derecognition gain to go to the P&L. Your scheme violates the standard, and therefore, I will not certify it.
So the auditor must actively withhold certification.
Right. They can't simply add an emphasis of matter paragraph to soften the blow. They must reject the treatment.
That takes some spine. But the source text also acknowledges a much darker kind of pragmatic reality here, doesn't it?
It does. It explicitly notes, however, court may give an order irrespective of whether the auditor certifies positively or otherwise.
This is the paradox. The auditor refuses to certify, maybe issues an adverse report, but the company just takes the scheme to the judge anyway.
Right, and the judge is evaluating the scheme based on corporate law, creditor protection, shareholder equity, not necessarily the nuances of Ind AS.
So the judge might just approve the scheme and issue the order mandating the reserve treatment anyway.
Yes. But even in that scenario, where the company is holding a literal court order in their hands, the source maintains that the financial statements must still strive to present a true and fair view in accordance with the applicable reporting framework.
To understand the sheer stubbornness of the standard here, we have to look at the specific rule the author invokes. He pulls in paragraph 7 of Ind AS 8, right?
Yes. Ind AS 8, which covers accounting policies, changes in accounting estimates, and errors.
Right. And paragraph 7 is essentially the supremacy clause of Ind AS.
It really is. It states that when an Ind AS specifically applies to a transaction, other event, or condition, the accounting policy applied to that item shall be determined by applying that specific Ind AS.
Shall. That's the imperative word. It doesn't leave room for management discretion or alternative legal avenues or anything else.
Precisely. If there is a standard that covers the derecognition of an asset, and there clearly is, you must apply it.
Is there any way around it?
Well, the only way you could legally bypass it is if the standard setter explicitly wrote an exemption into the standard itself, like carving out common control transactions or transactions mandated by court order.
And I'm guessing no such exemption exists for X Limited in this scenario.
None. The ITAI and the standard setters deliberately chose not to create a common control exemption for standalone statements.
Why not, though? Wouldn't it make things easier?
Because if they had, corporate groups could just infinitely shuffle assets back and forth between subsidiaries at artificially inflated premiums.
Oh, right. And they'd entirely bypass the P&L while doing it.
Exactly. They could use those artificially bloated equity reserves to secure localized bank loans or alter the standalone credit risk profiles of individual entities.
That sounds like a massive loophole.
It would be. The standard setters closed it by insisting the standalone reality must be reflected objectively.
This actually leads to the most revealing sentence in the entire source document. The author completely exposes the actual motive behind all this intricate maneuvering.
It's a great line.
Yeah. The text states, "The company cannot detract from recognizing a gain and avoid potential tax liability under the garb of common control or mirror accounting."
Avoid potential tax liability. That is the crux of the issue right there.
It's rarely just about clean accounting, is it?
Almost never. It is almost always about shielding capital from taxation or shareholder demands.
So let's break that down. If X Limited recognizes that 50 rupee gain in its profit and loss statement, it immediately inflates their reported book profit.
Right. And in the Indian tax jurisdiction, that directly exposes them to the minimum alternate tax, or MAT.
Ah, MAT. So even if they don't have regular taxable income, maybe due to prior losses or specific operational deductions, a massive spike in book profit forces them to pay MAT anyway.
Exactly. And furthermore, a massive reported profit might trigger demands from minority shareholders for increased dividend payouts.
If they see a profit, they want their cut.
Yep. But if the company can launder that P&L gain directly into the equity section by convincing a court to approve a scheme, routing it to a capital reserve,
The gain just vanishes from the headline earnings.
poof, gone.
Wow. It shields the company from the immediate MAT liability, it suppresses the expectations of minority shareholders, and the ultimate controlling parent successfully hoards the wealth within the corporate structure.
All while entirely subverting the transparency Ind AS is designed to enforce.
The author is highlighting a severe warning here for retail investors. Companies cannot utilize the excuse of corporate family dynamics or this flawed logic of mirror accounting to evade basic transparency.
Or even the heavy machinery of the legal system, frankly.
Right. It fundamentally changes how an analyst must view a simple internal sale.
It really does.
Yeah.
But, the user who submitted this query to Gap Advisors makes one final, highly creative attempt to avoid the P&L.
Oh, yeah, the third question.
Yeah. It brings us to their last attempt,
Yeah.
they ask. If mirror accounting is conceptually baseless, and if the court scheme cannot override paragraph 7 of Ind AS 8, can X Limited simply account for this entire transaction as a dividend distribution to Y Limited?
Oh, that is a clever pivot.
Isn't it? By trying to recharacterize the transaction as a distribution to owners in their capacity as owners, they're trying to utilize a completely different accounting mechanism.
One that inherently bypasses the P&L and adjusts equity directly, right?
Exactly.
But to understand why this falls apart, we have to entirely shift our perspective. We have to look away from the standalone books and look at the consolidated financial statements of the overarching corporate group.
Right. When we zoom out to the macro level of the consolidated entity, so the combination of the parent and all its subsidiaries, we have to evaluate the economic reality of the transaction as a whole.
What actually transpired for the group?
Yes.
From the consolidated perspective, the retail business moved from one wholly owned subsidiary to the parent.
Correct.
And 200 rupees of consideration moved from the parent down to the subsidiary. So the assets just changed physical locations within the exact same corporate boundary.
Right. Therefore, from the perspective of the consolidated group, absolutely nothing of economic substance occurred.
Because the total assets of the group haven't increased or decreased.
Right. The total liabilities are unchanged. Fundamentally, there is zero change to the total equity of the consolidated entity.
Which completely destroys the dividend argument. I mean, a dividend is fundamentally a mechanism where wealth is extracted from the corporate entity and distributed outward to the shareholders.
Exactly. The economic value must leave the consolidated perimeter.
And the source text addresses this directly, doesn't it?
It does. It states that there is absolutely no distribution taking place here because the consideration of 200 rupees remains entirely within the group.
The cash never actually left the economic entity.
Right. And because no wealth was distributed outside the consolidated group, it is mathematically and logically impossible to account for this as an equity transaction or a dividend distribution.
It's simply internal circulation. You can't disguise a 50 rupee difference as a dividend just because it's convenient.
No, you can't. Now, to provide a complete picture of the mechanics, the author actually pivots back to the parent company, Y Limited.
Okay, let's look at the parent side again.
Because he wants to explain exactly why their treatment of the negative capital reserve is actually compliant, while X Limited's attempt to mirror it is not.
Right. Y Limited isn't just making up their own rules. They're strictly following a different standard that applies specifically to their side of the transaction.
Exactly. Because from the perspective of the parent preparing its separate financial statements, this isn't just the acquisition of an isolated asset.
What is it then?
It is a business combination under common control.
Ah, and that triggers a very specific regulatory framework. The author cites Appendix C of Ind AS 103, which governs business combinations.
Yes, Appendix C deals exclusively with combinations of entities or businesses under common control.
So what does Appendix C mandate for the parent in this situation?
It mandates a methodology known as a pooling of interests method.
The pooling of interests method.
Right. Because the ultimate controlling party hasn't changed. The parent does not use the standard acquisition method where everything is marked to fair value and goodwill is generated.
Okay, so no fair value markups, no goodwill.
Right. Instead, Appendix C explicitly requires that any difference between the carrying amount of the net assets acquired, the 150 rupees, and the consideration paid, the 200 rupees, must be recognized directly in the capital reserve.
Okay, so when we synthesize all of this, we are left with this dual reality that perfectly illustrates the rigor of Ind AS.
It's a really elegant framework when you see it all together.
Through the standalone lens of X Limited, they sold a retail division for more than its carrying amount. Therefore, they must recognize a 50 rupee gain in their profit and loss statement, exposing that profit to taxation and shareholder visibility.
Yep. And simultaneously, through the separate lens of Y Limited, they executed a business combination under common control. Following Ind AS 183 Appendix C, they log the assets at book value and route the 50 rupee premium directly into a capital reserve.
So there really is no mirror. There's no symmetry at all.
None. There is only strict, isolated adherence to the specific accounting standards designed to capture the unique economic reality of each distinct legal entity.
It is a complex system, but it is deeply logical. When applied correctly, it actively prevents the kind of financial obfuscation that distorts market valuations and hides underlying credit risks.
It really does.
Which brings us back to our initial metaphor. The financial statements are not a simple photograph. They are a complex language.
And if companies are willing to go as far as drafting elaborate, legally binding court schemes simply to try and reclassify a straightforward 50 rupee gain into a hidden reserve just to shield it from the mat, it forces investors to ask a rather chilling question.
What's that?
Well, if a corporate group is willing to engineer a transaction this aggressively just to bypass the standalone P&L for a simple internal transfer,
Yeah.
you have to ask yourself what else is going on.
Oh, absolutely.
What other massively complex, highly structured internal transactions are currently hiding in plain sight within the consolidated statements of the mega corporations in your portfolio?
Right. If you're only looking at the consolidated headline numbers and ignoring the standalone realities and the specific Ind AS syntax governing them, you're just flying blind.
You cannot just read the translated novel. You have to understand the grammar of the translator.
That is a perfect way to put it. This has been an incredibly illuminating deep dive into the mechanics of Ind AS. I want to thank our audience deeply for investing your time with us today.
Yeah, thanks for tuning in.
Grasping the combative reality of applying Indian accounting standards where the spreadsheet literally has to hold its ground against court schemes and tax avoidance strategies is essential for anyone serious about corporate finance.
It is always a privilege to unpack the real-world application of these standards. The profession really relies on practitioners who understand the underlying philosophy, not just the surface-level journal entries.
It truly does. And before we conclude, I have a request for our listeners. If you found value in today's rigorous breakdown, please take a moment to follow or subscribe to the Gap Advisors NDS Clinic podcasts.
Yes, please do.
You can find the show on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen to Gap Advisors Ind AS Clinic podcasts on. Hit that subscribe button so you are notified of every new analysis.
Continuous exposure to these complex scenarios is absolutely the best way to sharpen your technical diagnostic skills.
And we need your help to elevate the standard of reporting across the entire industry. Please share this deep dive among your contacts, your colleagues, your audit and finance teams.
Sharing this knowledge is so important.
It is. And I want to make a special plea. If you know any students currently pursuing their CA course, send them this deep dive immediately. Understanding how Ind AS interacts with legal schemes and tax implications in practice, far beyond the textbook theory, will spread the knowledge on the application of Indian accounting standards and give them a massive advantage in their careers.
Definitely.
Thank you all once again for joining us. Keep questioning the underlying mechanics of the numbers, and we will see you on the next deep dive.